Hi, everybody. Welcome to Stop Being Sold, a community of informed consumers who are sick and tired of being sold financial products they don't understand or need. So if you're tired of being in transaction, go ahead and hit that notification bell and also the subscribe button so you never miss another video from us. How are you today, Brian?
Doing great, Michelle. How about yourself?
Doing good, thank you. I'm excited for today's video because we're going to be talking about bonus annuities. What are they, how they work, and are they too good to be true? So I'm going to turn it over to you. What the heck is a bonus annuity?
Okay, basically, Michelle, it's an annuity that provides you a bonus to incite you to purchase the product, okay? And it comes in several different forms. But to get started, today we only want to cover a fixed annuity and an indexed annuity. Just to keep it simple. I don't want to go into the variable annuity side of it because of the fluctuation in the market and all that. Let's just keep it simple today.
Okay, and real quick, when you talk about fixed, does that also include the multi-year guaranteed annuities and MIGAs? Okay, so MIGAs and fixed. Okay.
Yeah.
So MIGAs, fixed annuities, and fixed index annuities, we're leaving variable out of it.
You got it. Yep.
Okay. All right, so let's dive in.
Okay, so sometimes, Michelle, what you'll see in these bonus annuities is a premium bonus, okay? In the premium bonus, the bonus is paid on top of all first-year premiums that you deposit into that annuity.
Okay.
And they're usually seen with fixed indexed annuities, okay? So, for example, insurance company A could offer you a 5% bonus on all premiums you deposit in that first year.
Mm-hmm.
Let's say you deposit $10,000. The company then would add $500 bonus to the account. Now you would earn interest on your premiums deposited as well as the bonus that was given into the contract. So it's just like a teaser coming into the product. So.
And that's why you'll often see some contracts where it's higher the first year and then it drops back down. This is what that typically is. It's called a bonus annuity. This is a bonus. Okay.
Yeah, and that you'll see that there, Michelle, more in like the interest rate bonus. So what we first talked about was a premium bonus on top of your premium. Now we go to the normal fixed annuities, and some MIGAs will actually do this, not as much though, more towards just the fixed annuities. They give you an interest rate bonus, kind of like a teaser rate that you see like at bank CDs. Savings accounts. Hey, you open up this new checking account. We're going to give you $200, right? Okay, so it's a teaser rate. It's normally found in fixed annuities. And for example, let's say insurance company B could add an additional 1% of interest to your fixed rate during the first year of that annuity contract. In year 2, you drop back down to whatever the declared rate was. So.
Okay, can you have a premium bonus and an interest rate bonus at the same time, or do they typically pick one over the other?
Yeah, usually it's pick one or the other, in all honesty, and based on the product. You'll see more often, you'll see the premium bonus go with the indexed annuities and the interest rate bonus more on the fixed rate annuities. So.
Okay, all right. So this is basically free money from an insurance company.
Yes.
What's the catch?
There's, anytime anything sounds too good to be true, the devil's in the details of the contract. Your ears perk up. Does that sound right? But honestly, here are some scenarios where you may be offered a bonus annuity. Okay. Let's say making up for investment losses. This is very common. So let's say you're in the process of doing like a 401k rollover and you have $90,000 left in your 401k account, right?
Mm-hmm.
And you've probably lost $8,000 to $10,000 in the past year due to some market volatility. So for example, an advisor may offer to roll your funds into an indexed IRA annuity with a 10% upfront bonus. Sounds good, because what you could do is make up for most of your losses. So on a $90,000 portfolio, 10% bonus, they give you $9,000 up front. You're almost back up to that $100,000 that you had. Now moving forward, you can still participate in some of the upside potential of the stock market, depending on whatever your caps or your participation rates in that indexed annuity. So.
Okay. All right. So that was making up for investment losses. What's another scenario?
Okay, a common one we see, Michelle, is replacing one annuity contract with a new annuity.
Okay.
So let's say, for example, let's say you're in year 7 of your 10-year annuity contract and interest rates have moved up. You may start to see this in the next 12 to 18 months as we're going into a higher interest rate environment. So you're not happy as a consumer as you're still locked into a lower rate annuity and you have surrender charges to walk away from that product that you bought in the past. So an advisor may offer you a new annuity that has a bonus that may offset the amount of your current surrender charges, allowing you to earn higher rates moving forward. The bonus, though, would have to be higher than the current surrender charges, or many insurance companies would actually refuse to accept that replacement.
Okay. All right. Got it. So what's another scenario?
How about to increase your lifetime income payments?
Okay.
This is common for somebody wanting to take and turn on income in their annuity in the first couple years of the product. So let's say you've retired and you want to turn your old 401k into a guaranteed monthly income stream. It's funny today, Michelle, most of your 401k statements show you how much your account could equal in monthly payments if you retired today. So in this scenario, you may be offered a bonus annuity that would increase your payments by a certain percentage, like 7%, immediately or sometime in the near future. So you get a big jump start on the income payments. Imagine it, and instead of waiting 2 or 3 years to get a 7% return, you get a 7% boost, and then next year you turn on that income. So you've boosted that income up for you, and sounds good.
Okay, so quick question. So these 3 scenarios that you mentioned, does this typically happen? Would these bonuses be offered with the company that you're currently with? For example, like you said, one of them is replacing an annuity contract with another, right? Mm-hmm. Does it typically happen with your current company that you're holding an annuity with, or you have the agreement you have an annuity with, or can it be an outside company that's trying to get your business?
It would be so it would happen more typically. Your current annuity would not offer you a bonus to leave your old product because they've already calculated their profits into that old annuity. And for them to maximize their profits, you need to keep it to the end of the term. And that's why they have the surrender charges in there.
Okay. All right. Got it. Okay. So
it would normally be a new company.
All right. So what's you mentioned some of the pros of getting bonus annuities and how they work in the common scenarios. What are some of the downsides?
Okay. Traditionally, the higher the bonus, the longer the new surrender charges. So just like most annuities, bonus annuities have surrender charges. Mm-hmm. The higher the upfront bonus, the longer the insurance company wants you to stay in their product. Surrender charges will penalize you for wanting to take out more than the free withdrawal each year that's allowed, and if you surrender the contract before the end of its term. So that's one scenario.
All right. What's another disadvantage or downside?
Okay, so this is a big one here. The higher the bonus, the lower your potential earnings. Okay. So the upfront bonus can lower the potential annuity, your earnings in the future years. For example, Michelle, let's say you've purchased a 10-year annuity with a 6% upfront bonus from company A. Your $100,000 investment gets an initial $6,000 upfront, right? The insurance company offsets this expense with lower caps and rates for the duration of your annuity. So for example, this may only give you a cap of 2% of whatever the S&P 500 index earns, right? If you hit the cap, the 2% cap in all 10 years, you would, at the end of the contract, you would have $129,213.40. So 10 years, you've earned 29%. Okay. But if you take a different contract with, let's say, insurance company B with no bonus, and let's say it had just a 3% cap on the S&P 500 index, you hit the same cap for all 10 years. Michelle, you would have $134,391.16 for the same 10-year period.
Same 10-year period. Okay.
And you got to look at the upfront bonus, Michelle, is like an advance of future earnings. We're giving you all that money up front,
Sure.
but the rest of the years, you may not earn that much. Be very careful on that. And that's why you want to shop around and match up different contracts and have someone run that scenario for you.
Say, run the numbers, do the math.
Run the numbers, yes, because I don't care how high that bonus is. If you've reduced my earning potential and locked me into a 10-year product, or sometimes as high as a 16-year product, you've got to be careful on that. So
right. And I mean, in our scenario here, it's a what, roughly, I don't know, $5,000-$6,000 difference, give or take.
On 1% difference.
1%
bonus.
Exactly. But you start adding more money to that, it's a bigger,
bigger numbers.
I don't care. $5,000 is $5,000, right?
It sure is.
For the same amount of work, same amount of everything, you might as well maximize it. Okay. So you mentioned higher the bonus, the higher the surrender charge. I mean, excuse me, the higher the bonus, the longer the new surrender charge can be.
Yep. Can be.
Also, higher the bonus, the lower your potential earnings.
Yep.
What's another? Are there any more disadvantages?
Yeah. Some of the new contracts, Michelle, if you get a big bonus up front, your bonus may be vested. Now, we've heard that vesting word before in the 401k space, but many bonus annuities have what's called a vesting schedule. For example, your bonus annuity may have a 10-year surrender charge period, right? As well as a 10-year vesting schedule. Each year that you keep the annuity, the more the bonus you get to keep. The vesting schedule would only be negative to you if you have to surrender that contract early. So if you keep it the whole 10 years, the vesting schedule doesn't matter. But let's say you're in a 10-year contract in year 5, you got to liquidate the account. Not only do you pay the surrender charge after 5 years, but you have to give whatever that percentage that is declared of that bonus back to the insurance company with your surrender.
Okay.
So you got to be very careful on that.
All right. So we talked about running different scenarios, and you mentioned shop around. How many, if I was shopping around today for an annuity, say an index, a fixed index or whatever, it doesn't matter. How many contracts should you be looking at?
I would look at several. And again, first of all, Michelle, determine what you want to do with your annuity. Okay. What's the purpose of it?
What's the purpose of it?
Yeah. Do you want to, are you buying this, or are you looking to purchase an annuity to eliminate stock market risk? Right. Are you looking to purchase an annuity to turn on income immediately or sometime in the future? Are you looking for the safety and the guarantees of an annuity? And again, shop around, look at a minimum of 3 different annuities and just
different types or different contracts?
Different contracts. And then also, Michelle, maybe you also want to look at different advisors too, because some advisors are only contracted with one company. So they may specifically work for XYZ insurance company, where a annuity professional may be contracted with 50, 75 different annuities.
Absolutely. And then he or she then can help you make the best decision and choose the best contract or company, and not just limited to one.
Your specific needs. Yeah,
for sure. Okay.
And that's Michelle, that's one of the biggest issues with being sold annuities is no one just hops on the internet and said, hey, today I want to buy an annuity. That just don't happen. 3 to 5% of the people, maybe. Okay. But the majority are sold annuities. And you have to understand that they're okay. They're great products if they meet your specific needs.
Sure. Okay. And the way you know that is to read the fine print. Know what you want, set your goals, and read the fine print, right? Because they do vary from contract to contract and from company to company. So awesome. Is there anything else about bonus annuities?
Just be careful. In closing, be careful with them. Understand what you're buying. Read the fine print. If you don't understand it, reach out to us here at Stop Being Sold, and we'll have professionals go over contracts with you. Stay tuned also, as we will start reviewing specific annuity contracts that are available on the market today. So
Sounds great. All right. If you like the content of this video, hit that thumbs up sign, give it the like button, hit the like button, and also make sure to subscribe so you don't miss another video from us. Thank you, Brian, and thanks to everybody for watching.
Thanks, Michelle. Have a great day.